Hi, welcome to this my second data update for 2025. In this session, I want to focus primarily on US equities. If you remember, in the first update for this year, I talked about how US equities continue to dominate global markets. Their market share increasing from 42% at the start of 2023 to 44% at the start of 2024 to 49% at the start of 2025. As to how they increased their dominance, the answer is a pretty simple one. The US equity markets delivered returns of close to 25% in 2024. That's a good return, but what made it even more impressive was it backed up to a return of 25% plus in 2023, back-to-back good years. I want to take a closer look at US equities in the aggregate, what happened in 2024, and put it into context of history as to what kind of year this was for US stock investors. So let's start the process. I took a look at the S&P 500 by month in 2024. And as you can see across the year, it was a good year, but not every month delivered positive returns. In fact, in April of 2024, the S&P 500 was down about 4.16%. Collectively, though, the year was a good year. The first half of the year was a much better half than the second half. First half of the year, US equities were about 14.5%. The second half, they were up about 7.5%. I'm not looking a gift horse in the mouth. Overall, a good year. If you look in terms of returns, that gives you the returns from price appreciation, the index going up. And during the course of the year, the index was up about 23.31%. There are dividends, and those dividends in 2024, if you count in the estimates for it through December, was 74.83. As a percentage of the index at the start of the year, the dividend yield is 1.57%. Returns are always computed based on start of the year numbers, and my overall return for 2024 was almost 25%, it was 24.88%. Now, as you look at the 24.88% and say, was that a good year, was it a bad year? Let's let the data answer that question. In this graph, I have annual returns on the S&P 500 going back to 1928. That's quite a feat since the S&P 500 was created as an index in the mid-50s, but I've kind of reverse engineered by looking at the largest market cap companies before 56. So these are annual returns, and without even looking at the numbers, you can see that stocks are volatile. Out of the 97 years of returns I have in this graph, 71 were positive return years and 26 were negative return years. So there are a substantial number of years where stocks were down for the year and delivered negative returns. The worst year is minus 43.84%. That's 1931, the Great Depression year. The best year was from the mid-50s, a 52.56% return. I've also specified the first and the third quartile. So if you're getting a sense of where does 24.88% fall, it falls towards the top end. Not quite in the third quartile, but close to it. In fact, I looked at 2024 and looked to see how it ranked relative to other years in my history. As a single year return, 24.88% is good, but not great. It's the 27th best year across the 97 years that I've returns for. If I combine 2023 and 24, remember I said 2023 was also a good year, returns of more than 26%. The cumulative return in the S&P 500 is 57.42%. That's one of the 10 best two-year periods in US market history. So in case you're curious, we've come off 2 really good years for the stock market. Now, one way to think about returns in stocks is to look at what you'd have made on a riskless alternative. And for much of the last century, that riskless alternative would be investing in treasuries, T-bills or T-bonds. And to look at what 2024 looked like on that differential, it looked great. My equity returns were 24.88%. Looking at T-bills, though, the returns were about 4.97%. I'm looking at 3-month T-bills over the course of the year on average. I'd have made about 19.91% more investing in stocks than in T-bills. It gets even better when I look at T-bonds. My return on T-bonds in 2024 was negative. You're saying, how can they be negative? They're guaranteed. The coupons are guaranteed. But interest rates went up during the course of the year. And when interest rates go up, the price of the bond drops. The return is minus 1.64%. You take 24.88%. you subtract out minus 1.64%, my equity risk premium in 2024 is 26.52%. So in 2024, stocks beat treasuries, T-bills, and T-bonds handily. You knew that already. But remember, that equity risk premium goes up and down. It can be negative. It can be part of the reason you earn a risk premium in equities is because it's risky, stating the obvious. So one way to look at what this number has been over time is to average it out. So on this page, I've actually computed the average equity risk premium, the difference between stock returns and T-bills, 3-month bills, stock returns and T-bonds, 10-year bonds. I've computed an arithmetic average as well as a geometric average. You're saying, what's the difference? The arithmetic average, I take 97 years of stock returns and take a simple average. In the geometric average, I look at the compounded return. What does that mean? You go up 10% and you drop 10%. You actually end up below where you started because of the compounding effect. It's a much truer measure of returns. And I've computed the risk premium on both measures. I've computed against T-bills and T-bonds. And for different time periods, 1928 to 2024, the last 50 years, the last 10 years. And basically, you can see the premiums can vary depending on the slice of history you look at. Now, my initial equity risk premiums are all nominal. What does that mean? Inflation is embedded in them. They're returns you'd have made actually on your portfolio. But it's true, inflation imposes a cost on investors. It takes away your return. The effect on the risk premiums is much smaller though, and here's why. Inflation makes your returns on both stocks and T-bills low, and stocks and T-bonds lower, so the risk premiums remain substantially unchanged. These are called historical equity risk premiums. Over the last century, if you're an investor, investing in US equities would have delivered far higher returns than investing in T-bills and T-bonds. Don't overlearn from this. Don't assume that stocks are always better than bills or bonds. They were in the US over the last century. I know there are books out there that claim stocks always win in the long term. That's not true. If they always won in the long term, why would they be risky? You invest in the Nikkei in 1988, you might never make your money back in this lifetime or next, especially if you consider the time value of money. There are some markets where you will not catch up, but in the US, you were lucky. Now, there are practitioners out there who use these equity risk premiums. You're saying, what risk premiums? The risk premiums from this table when they value individual companies as their expected equity risk premium for the future. I have qualms about that for 3 reasons. First is, when I said these risk premiums, notice the plural. There are 12 different numbers here, 24 if you consider nominal and real. Which one are you going to use? Well, if you're a biased analyst, you're going to find the one that best fits your story. So that's the first problem. The second is, you are assuming that things will revert back to the way they used to be. You're saying, what's wrong with that? Well, what if they don't? What if there's been a structural shift in the global economy and you're going to go back to what the US earned over the last century? And third, even if you can get past the first 2 problems, you have to remember your statistics. When you compute these historical averages, they come with standard errors. So let's take a try at this. If I told you the equity risk premium for stocks over T-bonds was 7%, that's the arithmetic average, or 5.44%, which is geometric average, it behooves me to also tell you that the standard error in that number is 2.12%. You're saying, what does that mean? That there's a range around my estimate of about plus or minus 4%, that my true risk premium could be as low as 3 or as high as 11%. That makes these premiums almost useless. We'll say, the response that people often give is, what choice do I have? I'll give you a choice, but this has become the standard of estimating equity risk premiums, and I'm just putting a cautionary note on that. So with that said, let's take the question that I'm sure most of you came to this session with, which is, are stocks overpriced today? I'm going to scare you even more, and perhaps at the end bring you back to earth. Let's start with a scary number. One of the metrics that we use to judge how stocks are priced is the PE ratio. And let's face it might be old-fashioned, but everybody kind of understands what it is. It's the price per share divided by earnings per share. In the case of the index, it's the market cap for the index divided by the earnings for the index. Doesn't mean that there isn't room for nuance, because that earnings in the denominator can be earnings in the last fiscal year, current PE, the last 12 months, which is trailing PE, or the next 12 months, which can be forward PE. I computed PE ratios using trailing earnings, but I computed three variants. One is just market cap divided by trailing earnings, a simple PE ratio. But the problem with using trailing earnings in the most recent years, earnings are volatile. They go up and down. So the second measure I compute is a normalized PE. What's normalized? Well, I take the average of the last 10 years' earnings and I compute the PE ratio based on that average, kind of smoothing out the volatility. The problem with smoothing out volatility is if there's inflation, earnings from 10 years ago and earnings today are not quite comparable. So the third measure is to take that average earnings over the last 10 years, adjust for inflation, and come up with what's called a CAPE, C-A-P, or a Shiller PE. Now, I'm not a great fan of these multiple measures because they all tell the same story. The trailing PE for US equities at the start of 2025 was 24.15, much higher than it's been in any of the decades starting in the 1970s, much higher than it was even the last 4 years. The normalized PE with an average earnings of the last 10 years is 35.18, again higher than any of the numbers historically. You look at the Shiller PE, 30.55, again higher than historic numbers. On every dimension, stocks look overpriced. You're saying, oh my God, let me go sell my stocks. Not so fast. The problem with looking at PE ratios across time is they don't factor in the reality that interest rates change over time. One reason PE ratios have been higher for much of the last decade is the alternative, where you invest your money in T-bonds, has delivered such low rates. So here's a simple way to bring that in. If you take the PE ratio and invert it, earnings divided by price, it's called the earnings yield. The advantage of the earnings to price ratio is you can compare it to the T-bond rate. This is a graph that starting in 1960, I compute the earnings to, 1960, I compare the earnings to price ratio to the T-bond rate. It's a widely used measure in Wall Street. At the start of today, I've actually, just before I did this session, I got two calls, one from the Wall Street Journal and one from the Financial Times. And both start with the premise that the world was ending. You know what had happened? At the start of 2025, the earnings to price ratio had dropped below the T-bond rate. You're saying, so what? This difference in the earnings to price ratio and the T-bond rate has been viewed as a measure of the equity risk premium. So how can it be a measure? If you assume the earnings to price ratio is the expected return on stocks, the world has ended, right? You're actually earning a lower expected return on stocks and on a guaranteed investment. But before you jump out of a window or do something rash, take a look at this entire period where that was true. From 1980 all the way through 2000, earnings to price ratios were lower than the T-bond rate and stocks did immensely well. So you're saying, what happened? The problem, I think, is in assuming that the earnings to price ratio is equal to the expected return on stocks. I don't think people who often use this as a proxy have thought through this fully because there are one or two assumptions you need for the earnings to price ratio to be equal to the expected return. So let's say your PE ratio is 20. The earnings to price ratio is then 5%. Under what conditions that the expected return on stocks? The first is we assume no growth. That if your company's earnings are going to be constant, so if the earnings of the S&P 500 are going to be constant from this year forever, in nominal terms, then you can get away using the earnings to price ratio. The other is a little more subtle. These companies will grow, but they grow with neutral investment. What does that mean? They invest in projects that earn a return roughly equal to their cost of equity. The return on equity is equal to cost of equity. If you're willing to make one of those two assumptions, then you can get away using the earnings to price ratio as your expected return. You're saying, I'm willing to make that assumption. Hey, before you do that though, let's look at the data. The actual earnings on the S&P 500 since 2000, good years, bad years, the fiscal crisis in there, have risen 6.58% a year on average. That's definitely much higher than 0%. So you're saying, what about the second assumption? What about the return equity? The return equity for the S&P 500 companies was 20.61% in 2023. And even if you averaged out since 2000, it's about 16.38%. Both much higher than the cost of equity. Put simply, the data is at war with both assumptions, which means the earnings to price ratio is not a good proxy for the expected return, which explains that previous graph where earnings to price ratios can be lower than the T-bond rate and the market can keep going up. Now remember, the limitation of the earnings to price ratio, it focuses on earnings today. It doesn't bring in expected growth. It doesn't bring in changes in cash flows over time. So about 30 years ago, I decided to create a more expansive version of the expected return that included growth and changes in cash flows. You've all seen how yields to maturity on bonds are computed. You take the price of the bond, you take the coupons and the face value. The yield to maturity is the internal rate of return that makes the present value of those cash flows equal to the price of the bond. I bring that to play in equity markets. At the start of every month, I take the S&P 500. I project out expected cash flows. You're saying, how do you do that? I start with the earnings and the cash flows in the most recent 12 months. Cash flows in stock include both stocks, buybacks and dividends. I bring into account the expected growth in earnings. And here I draw an analyst forecast for earnings. I know you don't trust analysts, but kind of hold on there for a moment. At some point in time, sooner rather than later, in this case at the end of year 5, because these are the 500 largest market cap companies in the US, I assume they will start to grow at the same rate as the economy. I've made this argument before, that in the long term, the best estimate for nominal growth rate in perpetuity is your risk-free rate. So I push the growth rate down to your risk-free rate. And along the way, I adjust your payout ratio to reflect the fact that to get that risk-free rate, you've got to reinvest some money. And I solve for the discount rate that makes the present value of my cash flows equal to the level of the index. That is my expected return in stocks. Think of it as an augmented version of what we do with the earnings to price ratio, bringing in growth, cash flows, and changes over time. If I subtract out the T-bond rate from that, I get an equity risk premium. It's just a more dynamic, fuller version of expected returns. So start of 2025, I did this. I took the level of the index. I took the cash flows in the most recent 12 months, 182.79, which was about 81% of the total earnings in that year. And then I projected out earnings in future years based on what analysts were projecting. Again, I'll come back and defend that I'm using an earnings forecast from analysts. They're pretty upbeat especially about 2025 and 2026 for a number of different reasons. That upbeat assumption shows up as a growth rate of 9.57%. And remember what I said, this doesn't last for a long time. Starting in year 3 or 4, I start lowering the growth rate down to 4.58%, which is the T-bond rate. So I've got my expected cash flows. I've got the level of the index. I solve for the discount rate. You're saying, where's the price appreciation? See that last term in the calculation? That captures my price appreciation because that's the value of the index at the end of year 5. If I solve for the discount rate, I come up with a discount rate of 8.91%. T-bond rate of 4.58%. That difference gives me an equity risk premium of 4.33%. So the first thing I responded to for both the Wall Street Journal and Financial Times journalists, when they said the equity risk premium has become negative using the earnings to price ratio, I said, not quite there with you because that assertion is not a fact. The equity risk premium has decreased, but it's not dropped to a negative number. It's 4.33%. What does that mean? If you buy US equities at the start of 2025, you're building in an expected return, which is about 4.33% higher than the T-bond rate. You're saying, well, then how do I use it to decide if the market is too high or too low? Every statement you make about markets can be restated in terms of the equity risk premium. So for instance, if you tell me the equity risk premium 4.33% looks too low for you, given the macroeconomic risk and the chaos that might be coming, you're basically saying stocks are overvalued. If you tell me the 4.33% looks too high, that should really be much lower for a lot of different, set of different fundamentals, then you're basically saying stocks are undervalued. And if you say, look, I'm not a market timer, you're effectively saying I'm going to take the equity risk premium as a given. Whatever you say about equity risk premiums tells me what I need to know about what you think about markets. So here's what it boils down to. Is the 4.33% at the start of 2025 a number that's too low, too high, or just right? A Goldilocks question. Now, I'm not going to do the on the one hand, the other hand dance because it drives me crazy when market strategists do it and they try to split hairs. I do think the 4.33% looks a little too low. Why? Because there are so many uncertainties coming up, right? Uncertainties about taxes, tariffs, the economy, inflation. I do think a higher premium. Will it be 6%? I don't think that high. Even 5% might be too high. But I think there's going to be some increase in the equity risk premium. In making that judgment, though, about the equity risk premium, it does pay to have some perspective on what implied equity risk premiums have looked like over time. So I have actually computations of the implied equity risk premium going back to 1960. At the start of each year, using no hindsight, basically with the data I would have had then, I have the estimated implied equity risk premium for the S&P 500. If you look at that graph, you can see the premiums were pretty stable in the 60s, rose during the 70s because of inflation, then went on an extended downward trend, hitting about a low of 2% in 1999. 2%, of course, is that the peak of the dot-com boom. There's a correction. The question is, where in this graph would you put the 4.33%? And there's something here for almost everyone, right? If you're sanguine about the market, you can look at the 4.33% and say that's pretty close to what the average has been since 1960, which is 4.25%. If you're bearish about the market, you can take the 4.33% and compare it to the premiums in this century, especially after 2008, where the premiums have been higher, 5.5%. Say, hey, 4.33% is too low a premium. It's the same thing as saying stocks are overpriced. So I'm not suggesting that one of those is the only path to take, but it gives you at least a framework for thinking about whether the 4.33% is a reasonable premium. There's another way to frame this, which is to value the entire index. And here's what I did. I took the S&P 500 and I decided to value the entire index. I do this at the start. Again, at the start of every month, you can do this if you wanted to. This was at the start of 2025. Index was at 5,881.63. I projected out the expected cash flows, and I'll concede I used analyst estimates of earnings for 2025 and 2026, and I'll let you push back on those. And I took the cash payout ratio from the most recent 12 months, which is about 81% of earnings were paid out in dividends and buybacks, and I adjusted that payout ratio over time to reflect the fact that if I want to deliver a 4.58% growth rate in perpetuity, which is where I push the growth rates to, I can afford to pay out only 74%. It's actually a very simple computation. If you know the growth rate and the return equity, you can back out what payout ratio you have. So you have growth rates that change over time, payout ratios that change over time, steady state in year 5. And I compute the present value using two key inputs. One is that the T-bond rate is what it is. I'm not taking a point of view on rates being high or low, and you might disagree with that. And an equity risk premium of 4.5%, higher than the 4.33%, but lower than the 5% which you've seen since 2008. What I get as a value for the index is about 5,261. That's about 12% lower than the actual index level. That would suggest the market is overvalued. Now, don't overreact. Basically, I'm not asking you to sell yet, because are there uncertainties? Boy, are there uncertainties. Every single number I've used could be wrong, right? The analyst estimates of earnings could be too high. My risk-free rate could change over time. There's already pressure on the T-bond rate. Maybe it'll rise to 5 or even 6%. My equity risk premiums could get higher if there's a market crisis. Now, rather than wring my hand about those uncertainties, I ran a Monte Carlo simulation where I took the risk-free rate, the T-bond rate, the equity risk premium, and the earnings number, which in my base case I've used the analyst estimates, and allowed all three to become distributions. And I got a distribution of values for the index. Now, if you look at the distribution, say, what do I get out of this? Well, if you look at the 50th percentile, I get a value very close to the value that I got in my base case, which shouldn't be surprising because my distributions are built for the variables are built around base case assumptions. But I get more information. If you ignore the minimum and the maximum as being extreme and take the 10th and 90th percentile, you can see the range of values for the index is between 4,500 and 6,200. Incidentally, these are values for the index today, right? So basically, I'm comparing to the price of the index today. At the index level at the start of the year, we were pretty close to the 80th percentile. How would I read that? There's an 80% chance with my assumptions the market is overvalued and a 20% chance it's undervalued. But it also gives me a way of understanding you. If you're bullish, saying, I think the market could go up. Yeah, maybe your point of view includes higher earnings, lower risk premiums, and lower interest rates in the future. At the same time, I wouldn't push back if you said you're bearish, because I can see a pathway that gets you there. Again, I'm not trying to impose my perspective on you. I'm giving you a framework for coming up your own. I don't give out market advice. It's not my place and it's not my job. It's not my money to tell you where to invest your stocks. But I do think that you have to form your own perspectives on what's coming this year. Right? So it could be the low taxes and less regulation that take front and center in your story. Or it could be higher risk in the global environment that become front and center. Use the spreadsheet, put your perspectives in, and come up with your own value for the index. I do think good investing requires each of us to take ownership of our decisions, whether it's asset allocation or which companies we buy. You can't blame Goldman Sachs or Jim Cramer when things go wrong. And I hope that the tools that I have made available help you take ownership of your own decisions. I hope you found the session useful, and I thank you very much for listening.